Tomorrow, we're going to get a read on the latest inflation data. Consumer Price Index report set to be released. Whether it comes in cooler or hotter than expected, there might be a way to protect your portfolio, no matter what. To discuss this, we've got David Wagner, who is the Aptus Capital Advisors portfolio manager. Dave, great to speak with you here. All right, so let's put this in context, put this in perspective, where we are in inflation right now and where investors can be positioning their portfolio going into and out of the print.
Yeah, Brett, thanks for having me back. But I would say that, deflation, it's become less of a market catalyst than what it was, say, 12 months ago. But I mean, who doesn't know that? I mean, there's a lot of things out there that the market believes that it knows right now. It knows that if inflation continues to come down, that we're likely going to see Fed cuts in September. I mean, look at the Fed pricing right now. We're looking at an 80% chance of a cut in September. But let me, Brad, say that in a different way. If this CPI report is a disappointment, say we get a core number around 3.4% or higher, or a headline number at 3.1% or higher. If we get that higher than expected number, then a quick, sharp drop in stocks, well, that shouldn't be too surprising because, again, it's widely known right now that inflation is falling, and two is that the Fed is likely going to be cutting in September. Bottom line, if CPI reinforces that message, the grind higher can continue. If it refutes that message, don't be shocked if we see some type of volatility in the market over the next week or two.
And so even with that volatility, because what you're talking about there is now we've gone from bad news being good news because then, and months ago, it was, okay, that puts us further towards the rate cutting pathway and that initiating. But now bad news is becoming bad news because it's signaling that the Fed might be behind what the markets were anticipating, or we might see even a recession. I want to get your purview, your own perspective on that. And then additionally here, I mean, in my inbox this morning, I'm still looking at emails with the headlines that say from a few different firms out there signaling, hey, stay invested right now, despite the volatility.
Yeah, no, you're exactly correct. I have one saying, and for some reason, it's very difficult for a lot of investors to comprehend, but it's very simple. Follow the tape. Follow what the market is telling you. And if you've already been looking and watching the fixed income market, say over the past, 4 or 5 months, you've seen the 2-year Treasury come down 100 basis points. You've seen the 10-year Treasury also come down 80 basis points. So I think if you're looking to, fleet to safety in case there's some type of bad report or a good report, I don't think it's in the fixed income area, perhaps, because you've already had quite some type of move. So the market is telling you, if you follow the tape, that we know that inflation is coming down. And we know that rates are also likely to be coming down as measured by the Fed funds rate. I think kind of the coy or the cool way to really play this market on following the tape, since there is an opportunity, in my opinion, on the fixed income side. But if we do see rates come down, the best asset class done always when rates are coming down are stocks. People always forget that stocks are one of the longest duration assets out there in the market. And if rates come down, I think that, a rising tide is really going to lift all ships in the equity market, probably a little bit more specifically on the cyclical and small cap side, obviously, but I would still want to be owning stocks in that type of environment.
Where would volatility net out for some of the larger cap tech names out there, those that have been darlings in the broader AI theme?
If we get a better than anticipated, CPI report here, I do believe rates will come down. And I think those magnificent 7 names, they're going to continue to be that funding mechanism, much like what we saw in the middle of July. And you saw that capital flow from the Magnificent 7 to some of the smaller cap cohorts, to more of the real estate investment trust areas, the utilities, and even some of the more consumer cyclical and the consumer discretionary area. So that's what I would probably expect. If we see a worse off, so a higher than anticipated CPI report, I do think that the flow of capital is going to remain with the Magnificent 7 because there's so much resiliency. There's so much pricing inelasticity that a lot of those companies have. And that's the new flight to safety. The flight to safety 10 years ago was the staples, was the utilities. But, in this new era of investing in AI and, the amount of profit margin operating leverage that a lot of these Magnificent 7 companies have, That's where the flow of capital doesn't go if investors are looking for safety. And so if you think that there's going to be volatility in the market, not just here in the near term, but over, say, the next 3-4 months, I'd be putting my capital in the Mag 7. And Brad, I actually don't think that's a consensus call. I think that's kind of the anti-consensus call, which makes me probably a little bit more even convicted in that thesis.
Just lastly, while we have you here, David, as we're thinking through the earnings calls that have already taken place, I have one note in my inbox, and it's forwarded from the chief economist at Apollo, and all of this looking at the amount of mentions on recessions and earnings calls here. And companies are talking less and less about recession on earnings calls, looking at and charting even back to 2006 at this juncture. What does that signal to you about how concerned companies are and what investors should expect, especially as it relates to what they're saying about their financial performance, even amid the macroeconomic environment where they're not talking as much about recession on these calls?
Yeah, bro, that's great anecdotal evidence. I would like to see where that figure stands, not just at the end of this week, but maybe at the end of like 2-3 weeks from now, because we're starting to see, especially this week, the more cyclical discretionary companies reporting. You have Home Depot, you have Walmart, you have Lowe's this week. Next week and the following week, you're going to get a lot more of the smaller capitalization companies that are a little bit more tied to the cyclical aspects of the U.S. economy itself. So I'd kind of like to see that data come through, in the next 3 weeks, because right now the market is so tied to consumer spending, and that's where a lot of people are seeing cracks in the macroeconomic data is on the consumer spending side of things. So I'd want to hear that management commentary if they're starting to see cracks, depending whether it's on the higher end cohorts of the income distribution or on the lower end.
David, always a pleasure to speak with you. Great to check in. David Wagner, who is the Aptus Capital Advisors portfolio manager. Thanks.
Cheers.